Welcome back. Now we're going to quickly look at the statement of financial position. Okay. In our previous video, we have looked at the comprehensive income statement and then we solve a particular illustration. Okay. Now today we're going to take a step further. We're going to solve. We're going to prepare the statement of financial position, and then we'll see how we'll treat depreciation and accumulated depreciation in this statement of financial position. All right. Now, following the same question, okay, we have read through the question. I'm just going to quickly highlight the additional information. We had our closing stock to be 75,000. We had depreciation of equipment to be 25% of cost, which I showed us how to do that. And then we had the one for furniture to be charged on the balance, 10% on the balance, right? So we are asked to prepare comprehensive income statement as well as statement of financial position, okay, for the year ended. Now we've done comprehensive income statement, and then from there we're able to deduce that our net profit is 968,000. Okay, that's what we're able to deduce from our comprehensive income statement. So we're going to be taking a step further to prepare the statement of financial position. So we always start with the name of the business, right? This is XYZ Limited, and what we are preparing is our statement of financial position. What we are preparing is our statement of financial position as at 31st December 2020. Okay, so I'm going to bring in three columns. Okay, going to bring in my currency sign. I'll be using three columns. Okay, now we're starting with our non-current assets. So I'm going to be using the method where I start with my non-current asset, I bring in current asset, then I less current liability to arrive at my working capital. Okay, I'll be using that particular format. This is what we're going to do. So we're starting with our non-current asset. Okay, non-current asset, we had land and building. Now the thing is, okay, the idea is this. So this first column, when we come to the non-current asset, this first column will be representing the cost of the asset. That is the original cost of the asset. So this is going to be the first column for cost. You can even indicate that so that you don't get confused. So this is the original cost of the asset. Okay, now this column, second column, is going to be for accumulated depreciation. Now this accumulated depreciation is for the year, for this current year ended, for the year ended. Okay, it is not the one in the trial balance. What you have in the trial balance is accumulated depreciation up to last year ended. So when we want to calculate, want to prepare the balance sheet, we have to use accumulated depreciation up to this current year ended. So it means you have to add last year's accumulated depreciation and then this year's depreciation. Okay, so that you can have it up to this year ended. Okay, so we have to understand that. So this accumulated depreciation for the year end, for this particular year ended, is the accumulated depreciation or the provision for depreciation in the trial balance. Then we are going to add the current year's depreciation, which we have already worked or calculated in our comprehensive income statement, to give us our total depreciation up to this year end. Okay, so we have for the first asset, and then the last one is our net book value, NBV. Okay, so our net book value. So our cost of the asset will less our accumulated depreciation to arrive at the net book value. Okay, or the carrying amount. Now we have, first of all, we have land and building. Land and building, L&B, okay, given to us at a cost in the trial balance to be 500,000. Now there was no information on depreciation for land and building, neither was there anything that has to do with accumulated depreciation. That means there was no accumulated depreciation both in the trial balance and the estimate. There was no information on depreciation. So it means our net book value will be the same amount, 500,000. Okay, now let's go to the next thing. We have another we had equipment. Equipment in the trial balance given the cost is 200,000. So we have 200,000. Now, for our accumulated depreciation for the year end, we're going to be adding our accumulated depreciation brought forward from the trial balance, and then plus the value of depreciation that was calculated at the year end. That is the value we used in our comprehensive income statement. Okay, that one was calculated. So we're going to add that amount to the brought forward accumulated depreciation in our trial balance to get our accumulated depreciation for the year end. Okay, so what we have in our trial balance brought forward for equipment as accumulated depreciation is 50,000 naira. Now we're able to calculate that depreciation for the year will be 25% of cost, and the cost is 200,000. 25% actually gave us 50,000 naira, which we used. So for the year end, what we're going to be having as accumulated depreciation for the year end is we're going to add 50,000 from the trial balance to 50,000 naira that we calculated in our comprehensive income statement as depreciation for the year. So we're going to be having a total accumulated depreciation of what? 100,000. We're going to less this from our cost to arrive at our net book value of 100,000. Okay. Now the next item we have is furnitures. So we have furniture's cost to be 100,000. So 100,000 is here. Our calculated depreciation, like I said, our brought forward is in the trial balance. Okay, that is all the depreciation from previous years that have been accumulated until last year is in the trial balance as our brought forward, which is 30,000 naira. Now we're going to add the one for the year, which we calculated in the trial balance, which was 10% of the balance, right? And that gave us 7,000 naira. So we're going to be adding that 7 to 30 to give us 37,000 as our accumulated depreciation for the year end. So we're going to be having accumulated depreciation of 37,000. Okay, so this is it. Our net book value now will be 100,000 minus 37,000, which will be giving us what? This is going to be giving us 63,000 naira. So at the end of the day, we'll have to add in all our non-current assets to give us the total non-current assets. And this will give us what? 663,000 naira. Okay, so I want to use, like I said, I want to use the method where we have to adjust for working capital. That means I will itemize our current asset and then we'll less current liabilities from current asset to arrive at working capital, which will then add to our non-current asset. Okay, so quickly, current asset. So I'm going to start from cash, and we have cash value here to be given to us as what? 1 million naira. Okay, our cash is 1 million naira. Now we have bank, but in this case, our bank value is on the credit side, like I said, and that automatically means that it's an overdraft. Okay, so that's a liability for us. All right, so we're going to keep bank as as a current liability. Now, after cash, the next thing we have is receivables. Okay, receivables value is given to be 430,000. So I'm going to bring in receivables. Okay, and then we also have lastly inventory is our closing stock. Okay, which is always out of the entire balance, is always giving additional information. Our inventory value here is given to be 75,000. Is given to be 75,000. All right, now we're going to have total current asset value of 1,505,000. Quickly, let's bring in our current liabilities. Okay, current liabilities we have here, we have payables, and then we have overdraft. Like I told you, our bank value was reflecting on the credit side instead of the debit side, so it means it's a liability. Okay, so we have payables for our current liabilities, and our payables amount here is given to be 100,000. So we are adjusting to less that. Okay, 100,000, and then for our overdraft is given to be 500,000. So our total current liability here is given to be 100 plus this, that's 600,000. Okay, like I said, we're going to less total current liability from total current assets to arrive at working capital. When we less this, we're going to arrive at 905,000 naira. Okay, we're going to add this is our, let me label this is our working capital. So we're going to add working capital to our total non-current asset to give us our net asset, okay, or capital employed. All right, so when we add this to our capital, our non-current asset, what we have is given to be 1,568,000 naira as our capital employed. Okay, our capital employed or net asset. All right, so quickly let us adjust for our finances. In this case, this business is just financed by equity because we don't have any long-term liabilities here. Okay, so we have our capital, we have net profit, which we calculated from our previous video in our comprehensive income statement to be 968,000 naira, right? So we have capital, we have our net profit, and of course we have drawings to affect our finances. Okay, so we're having, so we have capital, and the value of capital given here is 2 million naira. So our capital value is 2 million naira, and then we're bringing in our net profit, which we calculated from our comprehensive income statement to be 968,000 naira. And then lastly, we are going to deduct drawings. Okay, our drawings value is 1,400. So we have drawings value 1,400. We are deducting drawings. All right, so and that will give us a balanced amount of 1,568,000 naira. All right. So this particular video just educates us anyway on the emphasis is on also understand how we treat accumulated depreciation in the balance sheet. Okay, so don't forget, you are adding the depreciation that you've calculated for the year to the balance brought forward depreciation. That is the accumulated depreciation in the trial balance. Okay, I like to call it the balance brought forward because it means that you have added all the other money from other years and then you are bringing it forward to this year. So you have to add the one at the end of the year so that you can have the balance carried down to take to the next year. Okay, so with this, we've come to the end of our video on depreciation. The next thing we're going to look at on adjustment is provisions. Yes, a lot of people have actually asked about that video. So we're going to be looking at provisions step by step. We'll start from our provision for bad debt. We'll go provision for all the possible provisions we can look at, and then we'll call it a wrap up for adjustment. Don't forget to like this video if it was helpful to you. Subscribe to this channel if you haven't. And then you can click on the notification button so that whenever new videos like this drop, you'll be notified immediately. And of course, don't forget to share this video with as many as you can. We'll see you in our next class. Thank you.